Thank you, Nick. That was very inspiring. So today I'm going to speak about the role of alternative investments, call it direct investments, in enhancing portfolios. This is a pretty exciting space. I'm also going to speak about the unique issues that surround asset allocation in this space. It's essentially a 3-semester course condensed in 10 minutes. It's important, for this is going to be extremely integral to the new business direction of our firm. In the fitness of time, I expect to see a sizable component of our product mix, of our revenue mix, evolve from areas where we have really not participated. Moreover, it's also important for us to start thinking about these things, for it'll only help us raise the quality of discourse when we speak to financial advisors, when we partner with folks, and come across as thought leaders. It will help us garner more faith, more trust. It will help us redefine conversations that are really not happening in our industry. So that was the general genesis behind this 10-minute talk that Nick asked me to give. So on the right-hand side on the screen, you see traditional investments, stocks, large cap, small cap, mutual funds, bonds, cash. That's an area that most folks are intimately familiar with. But the exciting space is on the left-hand side, non-traditional investments, alternative investments. And these are not new. These are not new. Real estate is something that has existed for the last 500 years, 600 years. And within real estate, you have different types of real estate and different types of strategies. In private equity formats, core, value add, opportunistic, CMBS, in our space, non-traded REITs. You have private, and the real estate space is a space where we have dominant core competencies. The other area is private equity. Private equity is again broken up by venture capital, special situations, distressed, mezzanine investing. That's a space that's really not too amenable for ubiquitous retail distribution at this point in time. And the third space is hedge funds. There are around 20 different hedge fund strategies that span the entire gamut of directional, non-directional, semi-directional, and that is something that we are seriously thinking about as a good way to package by way of either alternative mutual funds, by way of creating structured products, by way of creating index-based products, and that's something that I think retail investors would really love. So what you see here is a fairly wide swath of cloth. It's important to be able to make sense of this, and so that we can provide appropriate advice, so that we are able to provide appropriate exposures to folks in fast-changing market regimes. This is an area that retail investors have really not had good exposure to, and there's a unique opportunity for us to be dominant here. So another way of looking at this space is to stop thinking in terms of wrappers. Is it a MLP? Is it a REIT? Is it traded? Is it non-traded? Is it in a private equity format? These are crutches. These are just semantics. If you think about first principles, how do people make money? What really are the sources of returns? Conceptually, this industry really needs a new framework, a new lens to look at returns. Returns really come from two sources. One is from traditional passive exposure to a bunch of fundamental market factors, essentially exposure to non-diversifiable risk. And that is return that can be got very cheaply. If you believe that the GDP is going to grow, the economy is going to do well, corporate earnings are going to grow, then just buy ETFs, just buy the S&P 500 at 15-20 bips. If you believe that interest rates are going to fall, just go long fixed income. This is very commoditized business, and the only way you can really increase your returns is by taking on more and more risk. That's not necessarily the right way to invest. I submit that the right way to invest is to have a mix of traditional passive-based investing and as well as active management, skills-based investing, the space that we spearhead. And these returns really come from things like security selection, stock selection, in our case, property selection, in the BDCA case, credit selection, asset selection. It comes from market timing, when to buy, how much to buy, when to sell. And it comes from the access that we have to networks. It comes from the ability to participate in inefficient markets. The markets that I'm speaking about are very inefficient. They are not like the large cap fluidly traded liquid market, and that's where the nuggets really are. So I think that the realm of direct investing should be an important part of portfolios, for it's going to be extremely accretive to portfolio growth. So direct investing is fairly different from traditional investing. So in this simple chart we can distinguish better. One is the absolute return nature of the beast. In traditional markets, if the market falls 30% and your investments fall 29%, you would clap yourself on the back and say that, hey, I overperformed the market, which I think is ridiculous. Yeah. It should all be about absolute returns, because those are the only returns that matter. When a market falls, your investments should not fall, and should they fall, they should fall much lesser than the market. And when the market rises, you ought to be overperforming that market. In other words, asymmetric risk returns. And that is what direct investing is all about, or should be all about in a perfect world. In direct investing, you may use leverage. Now, leverage can be good and bad, because it helps both exacerbate returns as well as magnifies losses if it's not done properly. Another thing is, in direct investing, returns do not come, as we spoke earlier, from just taking pure market beta. They're supposed to come from manager skill too. In direct investing, here's another concept, the concept of illiquidity. I keep hearing from people that, oh, this is illiquid, I don't like illiquidity. But if you think deeper about it, how much liquidity does a man need? If all you wanted was liquidity, just hold cash, just hold T-bills. But we don't do that. We don't do that because we are able to unlock the illiquidity premia that exists in illiquid assets. You forsake liquidity, and for that you make returns. So overall, what happens is managers in this active management space create what is called alpha, and people should be happy to pay us as creators of alpha enhanced performance fee for the value that we create and for the value that we appropriate. Investing really is all about making risk-return trade-offs. So this is Finance 101. On the x-axis, you have risk, a proxy for risk being standard deviation, the variation around a mean of returns, and on the y-axis you have returns. So, for example, you look at the yellow line on the screen. It's a traditional stock bond portfolio, and I just created this hypothetical running some numbers. So for a 6% return on the x-axis, you get a 10% overall return. And when you add alternatives to the mix, for the same risk that you take, for the 6% risk, you will see that the red line is higher than the yellow line. You're getting a higher return for the same amount of risk that you take. And you see that fairly consistently across the entire efficient frontier. So alternative investments have the potential to enhance returns consistently, provided they are done correctly. And this is something that we are going to speak about in a moment. Investing is also about adding uncorrelated investments to what you own. So negative correlation means that if one security moves in a certain direction, the security that is negatively correlated ought to move in the opposite direction. It's that maxim of don't put all your eggs in one basket. So I created some hypothetical portfolios and did a simulation, and we can see that adding alternative investments have huge diversification benefits. And you look at real estate right at the bottom, it has very little correlations to bonds, to equities, to private equity. And what is even more interesting is different alternative investment classes have very low correlation to each other, and that is a good thing. So endowments, ultra high net worth individuals are heavily invested in alternatives, and this is just a stylistic illustration. You'll see that the larger endowments have larger percentages of their investments in AI, and you'll also see that their returns have been much higher than those who have allocated less to alternative investments. And these numbers might look small. After all, what really is the difference between 7% and 10%? But this difference is a huge difference if you're talking about the fantastic power of compounding over 6, 7, 8, 9 years, which is what alternative investing should be all about. Now, having said all of this, and this is an important point, I want to stress that alternative investments can be a good servant but a bad master. And that's because credit risk, market risk, concentration risk, liquidity risk, these can interact in very uncertain ways. And in our industry, and including in large wirehouses, banks, asset management firms, a space that I know fairly intimately, almost nobody seems to be doing it correctly. And I've spent a lot of time and a lot of been part of lots of projects, and I believe we can bring a lot of that insight into our firm, and we can change this industry by drawing attention to issues that nobody else in our space is talking about. For example, you cannot use traditional mean variance optimization the way you would do in traditional asset allocation, because returns distributions in this space are not distributed normally. You have properties like negative skewness, kurtosis. Return series can be misinterpreted because you're not really accounting for that illiquidity premium that you deserve. You're not accounting for things like tradability. You're not accounting for things like you're forsaking rebalancing opportunities, the cost of lost opportunity. Also, this is all private space. And since it is private space, returns are all self-reported, and this creates an upward bias in indices. So you need to adjust for all of that. Also, once you give your money, like we have seen with so many of our competitors, what a manager does after that, you have very little control. Managers may dynamically change their strategies. So you need to account for strategy groups, put these things into rational strategy groups, into buckets to arrest the pernicious effects of strategy drift. So we've created a framework. Bill Kahana has been helping me a lot, and he's kind of set the stage about how we are going to go about this. We explicitly account for all of these biases. We use good statistical techniques to unsmooth these returns and create better asset allocation frameworks. So to kind of conclude, we've created a methodology that is complex. Certainly it's very complex. That is rigorous, that is thoughtful, that challenges traditional asset allocation methodologies, and it allows us to create better allocations, and it puts us ahead of others in our space.
Please pardon the interruption. Your conference contains less than 3 participants at this time. If you would like to continue, press star 1.
So to conclude, I can see a lot more than 3 participants here. Direct investments, when done properly, are good. They bring enormous value to strategic asset allocation. They allow for tactical asset allocation. We, with our existing programs, and we, with our future programs, will be reshaping this industry in a big way for retail investors. And it's important for us to start getting this language right, these concepts right, so that we come across as thoughtful guys that are ahead of the curve. And I'll be delighted to work one-on-one with any one of you who has an interest in this space. Thank you.